Tilray Brands, ticker symbol TLRY, is currently trading at $1.58, showing an intraday gain of 1.60%. The price has been active right from the opening bell, pushing up to a high of $1.60 from a previous close of $1.56 before finding some stability. While many eyes are glued to this small green number, thinking it's another typical day of cannabis sector volatility, they are missing the far more significant battle happening beneath the surface. The real story isn't about today's minor percentage gain. It's about the monumental pressure building from short sellers and the company's desperate race to prove its diversification strategy can work before the market loses patience entirely. This isn't just a stock waiting for legalization, it's a company fighting for its fundamental identity, and the outcome is anything but certain. Most investors who hold or watch Tilray are operating on a very simple and perhaps outdated thesis. Buy now and wait for the U.S. government to finally reschedule or federally legalize cannabis. The belief is that once that legislative domino falls, the floodgates will open, and companies like Tilray, with their international footprint, will surge. This narrative of hope has kept the stock afloat through years of punishing downturns. However, the reality on the ground in late 2025 is far more complex and arguably more perilous. While Washington, D.C. remains stuck in a perpetual state of political gridlock, Tilray is burning through cash, facing relentless competition, and battling a perception that its high-profile acquisitions have yet to deliver on their promises. The expectation is a legislative jackpot, but the reality is a tough, grinding operational challenge where every dollar of revenue is hard-won, and every quarter brings fresh scrutiny on its path to profitability. The market is slowly waking up to the fact that legalization might not be the magic cure-all everyone hoped for, especially if the company's core business isn't financially sound when that day arrives. Let's dissect the recent price action to understand the forces of play. Today's early morning spike to $1.60 on increased volume suggests a pocket of buying interest, but the inability to hold that level points to persistent overhead supply. This is a classic pattern for TLRY. Any sign of positive momentum is quickly met by sellers taking profits or cutting losses. Looking at the past month, the stock has been trapped in a tight range, struggling to break above key resistance levels. This isn't just random market noise. It's the visual representation of the war between long-term believers and a growing army of skeptics. The broader macroeconomic environment certainly isn't helping. With interest rates remaining elevated, speculative, non-profitable growth stocks like Tilray are out of favor. Institutional money isn't flowing into high-risk sectors. It's seeking safety. This means Tilray is heavily reliant on retail investor sentiment, which can be fickle and is easily swayed by headlines and social media chatter rather than deep financial analysis. Now, we have to address the elephant in the room: the immense short interest in Tilray. This stock is consistently one of the most heavily shorted names in the entire market. The percentage of its float held by short sellers is often in the double digits, a clear signal that a significant portion of the market is betting heavily against the company. The short thesis is straightforward and for many compelling. They point to Tilray's history of net losses, its ongoing need to raise capital, which often leads to shareholder dilution through the issuance of more shares, and the brutal price compression in the Canadian cannabis market, which has squeezed margins for all major players. These aren't just opinions, they are concerns rooted in the company's financial statements. For investors, it's critical to know where to find and how to interpret this data. You can track short interest figures on platforms like Fintel or Ortex. Pay close attention to the days to cover metric, which tells you how many days it would take for all short sellers to buy back their shares based on average trading volume. A high days to cover ratio can sometimes signal the potential for a short squeeze, but more often it simply underscores the conviction of the short sellers. What's your take on the rising short interest, smart money, or manipulation? Furthermore, investors should monitor the borrow rate. This is the fee that short sellers must pay to borrow shares to sell short. When the borrow rate spikes, it means shares are becoming scarce and demand to short the stock is high. This can sometimes precede a major price move either up or down. A rising borrow rate makes it more expensive to maintain a short position, potentially forcing some shorts to cover, but it also signals deep bearish sentiment. The actionable step here for any TLRY investor is not to simply hope for a short squeeze. That's a low probability gamble. Instead, use the short interest data as a barometer of market sentiment. Understand the arguments the bears are making. Are they valid? Is the company addressing these concerns in its quarterly reports? Ignoring the short thesis is like navigating a minefield with a blindfold on. It's a risk that is simply not worth taking. So, what exactly does Tilray do beyond its reputation as a cannabis stock? The company has undergone a significant transformation. Following its merger with Aphria, it became one of the largest cannabis companies in the world by revenue. Its business is split into several key segments. First, there's its Canadian recreational and medical cannabis operation, which remains a core part of its identity but has been hampered by oversupply and regulatory burdens. Second is its international medical cannabis business, with a particularly strong presence in Germany. This is often cited as a major growth driver, especially as European markets continue to liberalize their laws. Third, and perhaps most controversially, is its diversification into the U.S. market through consumer packaged goods, primarily alcoholic beverages. Tilray has acquired several craft breweries, including Sweetwater Brewing, Montauk Brewing, and a spirits company, Breckenridge Distillery. The strategy here is to build a distribution network and brand recognition within the U.S. so that when federal cannabis legalization occurs, they have the infrastructure ready to pivot and introduce THC-infused products. This diversification is the central point of the bull versus bear debate. Bulls see it as a brilliant, forward-thinking move by CEO Irwin Simon to generate revenue and build a U.S. footprint while waiting for legislative change. They argue that the beverage brands provide stable, albeit lower-margin revenue streams that help to offset the volatility of the cannabis market. The reality check from the bears, however, is that these acquisitions were costly, added significant debt to the balance sheet, and have plunged Tilray into the highly competitive and mature craft beer market, which itself is facing headwinds. They argue that management is distracted, trying to run a beverage company and a cannabis company simultaneously and failing to achieve excellence in either. The latest earnings reports show this tension clearly. While beverage alcohol revenue is growing, the overall company is still struggling to achieve consistent positive adjusted EBITDA, let alone actual net income. Comment below if you believe Tilray's beverage strategy is a smart pivot or a costly distraction from their core cannabis business. Looking ahead, the future of Tilray hinges on a few key catalysts and risks. The most obvious catalyst remains U.S. policy. The potential rescheduling of cannabis from Schedule 1 to Schedule 3 would be a monumental step, easing research restrictions and providing significant tax relief under Section 280E, which currently prevents cannabis companies from deducting normal business expenses. This would dramatically improve the financial profile of U.S.-based operators and could create a wave of positive sentiment that lifts all boats, including Tilray. Another major catalyst is Germany. The country's recent legalization of recreational cannabis for personal use and cultivation in clubs is the first step, and any further expansion of a commercial market would place Tilray, with its established German medical operations, in a prime position. However, the risks are equally substantial. The primary risk is continued operational underperformance and cash burn. If Tilray cannot demonstrate a clear and sustainable path to profitability, it will likely have to continue raising money through dilutive offerings, putting further downward pressure on the stock price. Competition is not going away. In Canada, the market is saturated, and in the U.S., whenever legalization does happen, Tilray will face a host of well-established multi-state operators that already have dominant market positions. The idea that Tilray can simply waltz in and take over is a fantasy. The success of its beverage strategy is also a major unknown. Can it truly grow these brands into national powerhouses, or will they remain niche players in a crowded field? In conclusion, the simple story of Tilray as a bet on U.S. legalization is dangerously incomplete. The expectation of a legislative windfall clashes harshly with the current reality of a company battling on multiple fronts, fighting for profitability, managing a complex international business, integrating a disparate collection of beverage brands, and fending off a legion of committed short sellers. The stock's price action today is a microcosm of this larger struggle. To truly understand Tilray, one must look past the daily noise and analyze the fundamental health of its core operations, the viability of its diversification strategy, and the very real threats highlighted by the significant short interest. The path forward is not a straight line up. It's a volatile and uncertain course where operational execution will matter as much, if not more, than any news out of Washington.